Imagine investing in a way that requires almost no effort, beats most professional fund managers, and builds wealth over time with near certainty. Sounds too good to be true? That's exactly what John Bogle, the legendary founder of Vanguard and the father of index fund investing, teaches in the little book of common sense investing. His approach focuses on simplicity, patience, and long-term growth, rather than short-term speculation and high-risk strategies. Instead of constantly worrying about market fluctuations, economic news, or the latest stock trends, Bogle's philosophy allows investors to take a hands-off approach that still delivers solid results. By following his method, investors can achieve financial success without the need for deep financial expertise or constant market monitoring. His strategies have been tested over decades and have consistently outperformed most actively managed funds. Investing doesn't have to be complicated or stressful. Bogle's approach shows that by sticking to a few key principles, anyone can build significant wealth over time. In this video, we'll break down the most important principles from this investing classic. If you want to retire wealthy and avoid common investment mistakes, stick around. The lessons here could change your financial future forever. These insights are not just theoretical, but have been tested and proven over decades. Whether you're a beginner or an experienced investor, the wisdom of John Bogle can help you navigate the complexities of investing with clarity and confidence. Even if you've tried different investment strategies before, this book provides a perspective that simplifies the entire process, making financial freedom more achievable than ever. Chapter 1: The Power of Simplicity: Why Index Investing Works. John Bogle's philosophy is built on one fundamental truth: most investors, including professionals, cannot consistently beat the stock market. Despite their expertise, vast resources, and advanced analytical tools, the majority of fund managers fail to outperform the market in the long run. This is largely due to inefficiencies, excessive fees, and unpredictable market movements that make stock picking an unreliable strategy. Even the most skilled traders and hedge fund managers find it difficult to achieve consistent outperformance, meaning that for the average investor, attempting to beat the market is even more futile. Over time, the stock market delivers steady returns of around 7 to 10% annually. However, actively managed mutual funds charge high fees and rarely outperform the market in the long run. Many investors believe that active management provides better results, but statistical evidence shows that most actively managed funds underperform index funds due to high costs and human error. The illusion of superior performance often vanishes when fees, taxes, and trading costs are accounted for. Bogle's solution: invest in the entire market through a low-cost index fund. Instead of relying on individual stock selection or market timing, index funds offer broad diversification and reduce risk by spreading investments across hundreds or thousands of companies. By holding a wide array of stocks, you avoid the pitfalls of individual company failures while still benefiting from the long-term upward trend of the overall economy. Instead of trying to pick winning stocks, you simply own a slice of the entire economy. By doing so, you ensure that your portfolio reflects the growth of the overall economy rather than relying on speculative bets that may or may not pay off. This approach eliminates the stress of trying to time the market or predict which companies will succeed, allowing investors to focus on long-term wealth accumulation instead. As companies grow and generate profits, your investment naturally compounds over decades. The power of compounding means that small gains accumulate exponentially over time, leading to substantial wealth creation with minimal effort or intervention. The earlier you start investing in index funds, the more powerful the compounding effect becomes, making it one of the easiest and most effective ways to grow your wealth over the long term. Think of it this way: rather than gambling on a single horse, you're betting on the entire racetrack. Over time, the economy grows, and you grow with it. This approach significantly lowers your investment risk while maximizing long-term returns, making it the smartest and most reliable way to build wealth over decades. With the right mindset and patience, anyone can use index funds to achieve financial independence, regardless of their starting capital or investing experience. Chapter 2: The Myth of Beating the Market. Many investors believe they can outsmart the market by picking individual stocks or timing when to buy and sell. Bogle warns against this illusion. The idea that a single investor, no matter how skilled, can consistently beat the collective wisdom of the market is a dangerous misconception that leads to unnecessary risks and losses. Wall Street thrives on the belief that professionals can outperform the market. But the reality is that even the best investors struggle to maintain an edge over long periods. Historical data shows that most professional fund managers fail to outperform the market over long periods. While some may achieve short-term success, maintaining above-average returns year after year is nearly impossible due to market unpredictability and increasing competition among traders. Even those who do succeed for a few years often see their performance revert to the mean, proving that luck plays a larger role than many are willing to admit. A study of mutual funds found that over 85% of them underperformed the S&P 500 after fees and taxes are taken into account. This statistic underscores the importance of minimizing costs and choosing a strategy that ensures maximum returns rather than chasing unrealistic gains. When accounting for taxes, management fees, and trading costs, most actively managed funds leave investors with lower returns than a simple index fund would provide. Even if a fund performs well in 1 year, there's no guarantee it will continue to do so in the future. Market conditions change, management strategies evolve, and luck plays a bigger role in investing than many people realize. The unpredictability of markets makes it nearly impossible to consistently choose winners, further reinforcing the importance of a passive, index-based approach. The best strategy: accept that you cannot outsmart the market and simply invest in it through an index fund. Instead of wasting time and resources trying to predict stock prices, focus on steady, long-term growth with a diversified, low-cost index portfolio. The earlier you adopt this mindset, the better off your financial future will be. This is what Warren Buffett himself recommends. In fact, Buffett famously bet $1 million that a simple S&P 500 index fund would beat hedge funds over 10 years, and he won. This bet proved that even high-paid investment professionals struggle to beat the market, reinforcing the wisdom of index investing for everyday investors. When one of the greatest investors of all time advocates for index funds, it's a strong indication that this strategy is the best choice for most people. Conclusion: John Bogle's investment philosophy is simple yet incredibly powerful. Instead of chasing short-term gains or trying to beat the market, the best approach for most investors is to invest in low-cost index funds, stay the course, and let compounding do its work. The more patient and disciplined you are, the more wealth you'll build over time. If you're serious about financial success, the best thing you can do today is to start investing in index funds and avoid the noise of Wall Street. The earlier you begin, the more powerful your compounding returns will be. Remember, successful investing isn't about excitement or quick wins. It's about steady, long-term growth.